Welcome to Live Wire Markets and our long-form interview series, Views from the Top. I'm Huntsley. Great to have you with us. Our conversation today is around all things fixed income. And there have been some remarkable moves across the curve, sparked by the rush into safe havens earlier this month. But unlike other periods of sharp volatility, this move seems to have stuck. So is that a portent of things to come? Well, joining me to answer those and other questions is one of the very best in the business. Adam Grotzinger is Senior Portfolio Manager for Fixed Income at Neuberger Berman. Adam's normally based in Chicago, but today it's a treat to have him here in Sydney. Welcome, sir. Good to see you.
Thanks. Great to be here.
So we last spoke in early June for the income series, which seems like 5 markets ago at this rate. Since that time, the US 10-year government bond yield has dropped to February 2024 levels, and credit spreads have widened to near hard landing levels. So let's just start there. What changed and what do you think happens next?
Yeah, I think, if you look at the events of market volatility here that we saw at the start of August and early parts of August, really I kind of put it down to a transition in the market's focus away from what the focus has been and the narrative has been the last couple of years, which is purely kind of an inflation and inflation control focus and where are we going there and where's central bank policy going and how much higher can it go, to inflation being more in control and behaving in the right direction, to we now need to look deeper into growth and what are the prospects for growth. And one of the triggers to that really was the payroll report, where the number was okay at the headline level, but certainly well below what consensus was or what the survey consensus was in the market. And I think that triggered a bit of a scramble and a rethinking to the quality of growth behind some of the numbers coming out of the economy, and what should we expect 12 months forward for kind of the degree of slowing in growth, and what does that mean for Fed policy, and then kind of a shift to the narrative in short.
Yeah, it's remarkable how we've had this conversation about inflation for 3 years, and all of a sudden like that, it's become a conversation about growth. So with that said, do you believe we have just witnessed a major turning point for markets?
Yeah, I do. We're seeing the markets kind of trade around a bit post that initial bit of volatility, and credit spreads have retraced and kind of come back in a significant amount. Yields have kind of calibrated back up. But I think the big move in rates we are anticipating to kind of a structurally lower bound and more of a range bound but lower boundary for rates happened. And so we've been advocates of it's hard to get timing right if you want to trade rates and be a bit longer rates, which we were coming into this. But that big move has happened. We've taken some profit off of that, and now we're settling into a lower trending range for yields, but kind of one that's going to bounce around for a bit as the market digests more data. But I do think it was a big shift in the market and kind of a demarcation point to kind of a new regime that the market's going to trade from a narrative point of view.
Interesting to that, of course, the Fed basically signaling that we've got a near guaranteed rate cut now in September. We're seeing firms like JP Morgan and Citi as well calling for potentially 50 bip cuts next month, possibly even November as well. I'm not going to ask you if you think the Fed will cut by 50 basis points, but let's say they do. What kind of signaling, what kind of messaging does that tell the markets?
Yeah, I would say, we do have a view on the path of the Fed, and I'd say the view's been very consistent over the last 12 plus months. And that view has been, firstly, let's get a consistent and a high confirmation view of what is terminal for the Fed. So, we've been advocates that the Fed needs to cut. They're at restrictive policy and terminal rates are 3.5%. What that kind of foundational view of Fed terminals enabled us to do is trade rates along the way as the markets traded cheaper rich to that expectation of Fed terminal. If you think about what happened here in August, the market went from almost viewing the Fed terminal of 4.25% to overnight 2.93%. So a huge shift in the market's expectations around the Fed now needs to cut. There's even talk of kind of an interim policy cut. I think we faded that view, and we think the Fed will cut, but kind of more in a graduated pace, in a consistent pace. So, our view would be we start in September, the Fed does 25, and they keep doing 25 for the next 8 meetings, and that gives you a terminal rate of 3.5 in 12-month horizon. The big shift is that we're pushing forward the speed of the Fed cuts from end of 2026 reaching of terminal to today in a 12-month horizon, in a 1-year horizon reaching terminal, but the terminal level in our view is still the same at 3.5%.
So, as you say, if you think this is the turning point, and you're talking about potentially 200 basis points worth of rate cuts, slowly but surely, through to the end of next year, what positions are you changing? What positions are you doubling down on in your fund strategy? Basically, if you've got this view, how do you actually put that into investment decisions?
Yeah, I'd say for the most part, we've been pre-positioned for this move. So a lot of the stuff we've had on, which has been higher quality versus lower quality, intermediate duration versus short duration, has been working and worked very strongly in the months of July and particularly in August. So that positioning has worked. We had on the positioning in advance of markets. The move in August enabled us to start taking some money off the table from that existing positioning, in particular reducing our duration. So we went from a 5-year portfolio duration down to 3.5 years on the initial strong move down in yields, realizing some gains from that movement in duration, and locking into kind of a slightly lower but still beginning of intermediate duration posture, 3.5 years. I think the challenge in the short term for duration is that the big move has happened. Now we're kind of settling into more range trading, and to implement a duration trading strategy, the negative carry is more significant than it was pre-August. And so you have to just be more acutely aware of the timing of those trades if you want to play duration than in the past. And so it necessitates taking a bit of risk off the table there in duration and monetizing some of our gains that we've had in agency mortgages. But the majority of our book is still, I'd say sensitive to more duration versus less, still sensitive to agency mortgages. But as this kind of narrative evolves in the market over the next 12 months, I think we're in a prime position to just continue to realize gains from that existing position and continuing to unwind it into the market, be in a position of better liquidity and optionality, and wait to see what the market presents us for the next opportunity. I think some of that opportunity should likely be in credit, where credit spreads are still relatively tight to historical standards. And as the economy continues to gradually slow, the open-ended question is, should credit spreads trade a little bit more two-way, and that two-way being a bit more widening versus tightening? So that's how we're thinking about the balance of risks and the prospect of opportunities right now.
You talked credit.
Yeah.
Let's go there. I was really interested to read this view from Michael Hartnett at Bank of America, who basically argued that a material widening in spreads, some of it you've alluded to just then, will prove that investors should be positioned for more pain down the road. I was checking credit spreads yesterday. US investment grade is now at 137 basis points, high yield very close to 400 basis points in terms of spreads. So, and that represents a widening, everybody, basically. So would you agree then with Michael's view? And are you seeing any early cracks in the US credit market? And is that something investors should be taking seriously?
I don't know if I'd be as doomsday of that view. I think credit is admittedly richer valued versus fair or cheap value. There's been technicals that have enabled that, more buying and demand for corporate debt than there has been supply. You look at the high yield market, it's kind of been net negative supply. And the economy, again, is not crashing overnight. It's slowing, but it's not crashing. And so I think, the reasonable expectation for credit is, again, in our view, a bit more of a two-way versus kind of a ratcheting tighter in spreads kind of market. But one equally where it's hard.
When you say two-way,
two-way, spreads kind of trading wider and tightening versus just strictly tightening, sure, which is what we've seen over the last couple years, is just a significant tightening in credit spreads. So maybe we get a bit more of a two-way movement in spreads and where they can go. We saw that in August, a bit of widening, then subsequent tightening. But it's hard to envisage, unless the economy is doing a hard landing, that credit spreads materially blow out. So I think the technicals are important to look at. They were the most important driver of credit spreads last year. I think they're still an important factor this year. And the economy, if it's not crashing, should still see some support for credit spreads, albeit we could trade at wider levels, and those can be trading opportunities to buy and sell different parts of credit. So I'd kind of view credit risk as something where you don't want it consuming the majority of your risk budget, but it's still reasonable to own some and then have more of a kind of tactical trading mentality on credit, at least for the next 6 to 8 months.
Quick follow-up on that comment of risk, on your earlier comments about quality. I take it that then reflects in the sectors or the particular industries that you're specifically after, right?
Yeah, that's right. If you look at our fund, when we were last max bullish on credit was really in 2021, 2020, kind of COVID and initial kind of subsequent couple years post-COVID. 2020, the initial volatility of COVID, we had 40% in investment grade credit. Today, what do we have? We have about 18% in investment grade credit, just to give you some contextualization of sizing. High yield corporate credit, or the non-investment grade markets, 2021 was our last max level of that. We had about 60% notional value in high yield corporate credit. What do we have today? We have about 10%. So we still have exposure, but significantly scaled down in size, and more focused on kind of like bespoke opportunities, idiosyncratic opportunities in the market versus kind of wholesale saying that this represents value.
Speaking of risk, I'm really curious to hear what you think is one other risk that markets are underestimating. I know there's the geopolitics, there's this story about defaults we've been talking about for a long time that doesn't seem to have come as a tsunami as maybe other people were expecting, but is there one other risk that you think markets are underestimating, or do you have a key point of contention that you're talking about in the Neuberger Berman War Room? What is it?
Yeah, I think one of them is fiscal. Fiscal continues to be topical. There's a lot of discussion around the degree of fiscal deterioration, particularly in the U.S. But the challenge in markets is, when is that an opportunity that's actually tradable? And when is that priced into fixed income securities, in the case of the U.S. as an example. And that's harder to have certainty of timing on. One, because the dollar is a reserve currency, so that takes longer to manifest itself in terms of reality of price action in the markets. But I do think, if we think about fiscal dynamics in the U.S. right now, the cleanest way of kind of expressing that in portfolios is just being more avoidant of long-end fixed income treasuries. Coming into the election window this year, the fiscal discussion and the markets kind of focus on that as we get closer to the election. I think it's reasonable to expect some volatility around that again. And so the problem with owning long fixed income when there's these fiscal concerns, long duration fixed income treasuries, is that you can have an assumption of fair value, but you could also kind of have a wider boundary of what that fair value could be. And you're in a long duration instrument where the price swings can be more sizable and you can be in a position of loss. So we're, I think, still skeptical and avoidant of long duration. If you want to express duration views and you're concerned about fiscal, the cleaner way to express that is kind of trading the front to intermediate parts of curves.
Move slowly up from the 6 month, 1 year, 2 years, all the way out. Yeah, no, I get what you mean. Before we come to the last question to close this interview, I want to circle back to where we began. We talked at length last time you were on the Livewire platform about the question you were getting most from investors. This idea of, why should I get out of cash? Now, people can still get 5% in many term deposits or money market funds with very few risks until the Fed starts cutting. In your experience, I'm curious, how much extra yield do investors typically demand to get out of cash? And obviously you'll be constructing the portfolio probably with those goals in mind, I take it.
I think the biggest thing when you think about moving out the curve versus a cash proposition is cash. You just get the yield, the sticker yield that's on it. You're not going to get any price movement in addition to yield. So it's kind of an income generative strategy, but it doesn't have any additional total return beyond the headline sticker of what those term deposits are paying you. Remember, too, that when the Fed or central banks cut, cash rates usually go down in advance of that. So there'll be an anticipation in the cash rate markets of those moves, and there'll be a realization of lesser income in advance of the actual move from central banks. So the question one should ask is, if I step out and buy a 2-year bond instead of cash rates, what's the deficit in carry I'm realizing? And think about basically a 2-year bond as being a series of 2 1-year bonds. Or the same thing for a 5-year bond. It's a series of 5 1-year bonds. So the simple math should be, does the yield on a 5-year bond, for example, over the next 5 years, is that more than what I get by just rolling 1-year bonds for those 5-year periods and what I expect for the level of central bank policy rates 5 years forward, right? So if we're expecting the central bank in the U.S. to cut 2% over the next 12 months, are you better off locking in the income level today a little bit further out the curve to have that durability of income versus the compression you're going to realize in cash rates.
To close us out, Adam, this is our series Views from the Top. We invite some of the world's best investors, Australia's best investors, to sit in that chair. Adam has been a professional investor since, 2007, I think, something like that, when he started Franklin Templeton. Talk about a baptism by fire in 2007. Point being, you've seen a thing or two in your time. So what is one thing you have become privy to that you would not have realized or had access to if it were not for the position that you're in today? Indeed, do you have a view from the top?
Yeah, I think one interesting thing to ponder and to think about and even act on today is, it's been a long time since duration has been a viable asset class in portfolios. If you think about from the GFC era all the way to COVID, there was very little interest from fixed income investors in trading and participating in risk-free assets and trading duration because the efficacy of that was relatively small and the return outcomes were relatively small. You had an artificially suppressed market from central bank QE. And so price discovery and price action was kind of muted and distorted by central bank policy. And there was a long period of zero or negative interest rates, depending on where in the world you're residing. If you look at the world today, it's almost complete opposite of that. And so, the perspective of being in markets for a long time is that we can once again now look at duration and remember the pre-GFC era of what that provided as an opportunity set when real rates are high, volatility is high, and that's a ripe environment for trading duration and risk-free opportunities, particularly when credit is tighter in valuation. So, one of the things we've been doing our strategy is shifting more risk budget back into duration trading strategies and benefiting from what the markets provided us there in terms of volatility.
Adam, this has been a wonderful conversation. It's been great to have you out here from Chicago. Thank you for joining us today.
Thank you.
And thank you for joining us. If you'd like to see more episodes of Views from the Top, you can subscribe to the Livewire website, our YouTube channel. And thank you very much for watching. We'll see you again soon.